$131,000 a year income and paying zero federal tax? Is that even possible? How the power of qualified dividends have changed things, and the one big beautiful bill has changed your tax strategies for 2026. We're going to explain it all today and break it down so you have a better understanding of why the proper funds in the proper area can help you generate more income down the road. Hey, it's Doug the Retirement Guy. Welcome back to the channel. We're getting back rolling after a couple weeks of vacation time. You always got to take time for the friends and family, get away, enjoy life. So let's get into today's video. Past performance does not guarantee future results. The information provided in this video is for educational and informational purposes only. It should not be considered financial advice, as I am not a professional financial advisor. I am just a regular retail investor like yourself. So here's the question that comes up to it: tax strategy. This whole thing actually came from one of our Patreon supporters that asked a question about, dividends. How does the tax system work? How does everything come about? And I started doing the research for him, and we've done some other videos on taxes. And I said, look, this is a simple way to explain it. If you're a W2 employee, this is what we call standard earned income. So if you generate $131,000, you're going to pay your FICA taxes, which is your Social Security and Medicare costs. You're going to have federal income tax, and that's going to vary by where you're at, and your deductions and all that kind of stuff. But everything is taxed like ordinary income rates. There's nothing special about a W-2. Everything just does is reduces your take-home pay. Now, if you've invested into dividend ETFs, dividend stocks, however you want to do it, and you had qualified dividend income, and we're going to talk about that. That's a little different, so you have to understand. Qualified, which means that's qualified for tax purposes. $131,000 of gross income through the dividend program, you'd have zero FICA taxes. There's no Social Security, there's no Medicare on any of that, because it's from investments which are exempt from FICA. The federal income tax, with proper strategy and the standard deduction and the zero bracket, you could actually come up with a zero tax program, which would be 100% tax efficiency by using the right investments, qualified dividend income. So our person that called us, they were sitting down doing their taxes. They're having a heart attack when they're sitting there saying, I'm looking at my portfolio statement. I had $98,000 worth of income. It was great. Phenomenal. I've been loving life the whole year. I got JPI, JPQ, some QQ. I don't know if they had QQI. I believe they had QILD. They just had some different funds that they said we've had some good success, great income, but now I'm looking at a huge tax bill. What did I do wrong? What's going on here? I don't understand it. Well, I said the danger of the wrong ETF. Okay, this is what we call the tax trap alert. It's the same income, but completely different outcomes. I said you have the wrong funds in the wrong location, and you have it in the basically wrong account, and that's what's going to give you a tax bill. The dividend investor earning the same amount of qualified dividends could have potentially owed nothing. But this only works if you own the right funds. So I'm not saying JPI or JPQ or any of those are bad funds, but you need to know where to put your funds properly to help you down the road in the tax side of it. I talked to my brother about this, and we both laughed as he just recently retired. He goes, you know what the difference is from retirement from working? He goes, I spend all my time now worrying about how to calculate taxes and how to put things into it and how to play with the rules of the game. Versus before, I just had to work. I said, yeah, things do change, but they actually get simple if you listen and learn. So in 2026, the standard deductions, okay, this is where everything becomes really crazy. And this is really where the magic of zero starts off with. So if a single filer, you're going to have a standard deduction for 2026 of $16,100. Head of a household, which is an unmarried person with dependents, are going to generate $24,150 in deductions. Now, if you're a married filing jointly, the power of the couple advantage, you're going to be up to $32,200 of automatic tax-free baseline deduction. Okay, so before the IRS takes a single dollar of your income, everything gets a free pass. And this is what we call our standardized deduction. So they've tried to make this as simple as possible. Now, step 2 is the 0% tax bracket. Okay, so when we get into this, qualified dividends and long-term capital gains is what we're going to fall into. These 3 thresholds apply to taxable income, not gross income. Big difference there. Okay, so you've taken your gross income, you've taken your deductions off of it, you now have what they classify as taxable income. If you're a single filer, you're going to be at $49,000 and still be in the 0 category. Head of household is $66,000, and a married couple is now $98,900. So again, gross income minus standard deductions gives you your taxable income to fit into these brackets. So you now have, as you can see, $98,000 for a married couple. So when you start stacking all of this to win, the calculation comes into this: combining your deductions and your brackets for a maximum efficiency. Standard deductions $32,000 for a married couple, 0 tax bracket of $98,000. That means the total tax-free income is $131,100. This is what makes it so critical. The hidden bonus: you didn't pay the FICA 7.65. Dividends are FICA free. There's no Social Security tax. So while a W2 worker loses over $10,000 of payroll on taxes, a dividend investor gets to keep it all. So number 4, we call it the vehicles. It's the workhorses that we have to have into this. Tax efficient ETFs for your taxable account. Now remember, we're talking 2 different accounts here. We're talking a brokerage account, which is just your regular taxable fund, versus a 401k or an IRA or anything like that. These are funds that people put money into it because they can trade off, sell off, do what they want to do to generate their income or dividends and so on. So what we approved by the taxable brokerage, SCHD, this is a simple one. A lot of people have this fund. A lot of people, this is a good known, and we've did this in our portfolio. If you're a smart asset portfolio, we say CHD is one of those funds in the growth package that you live off of. 95 to 100% of their payouts are qualified dividends. This is a high tax efficiency. They have a current yield about 3.32%. It's best for balanced and income growth. So if you've ever watched any of our videos that we talk about our 3 pillars of buckets to work from, this is CHD, goes into that income growth side of it. Another great fund, VYM, the Vanguard High Dividend Yield. Now this is about a 2.8. Again, it's immediate income for needs, but it also has a nice growth package qualifying at greater than 90%. And of course, VIG, which is a Vanguard Dividend Appreciation at 100% qualified dividends, smaller yield, but these are long-term tax-free growth machines. So these are ones that you can put into a regular account, your regular brokerage account, and still it's coming to you as qualified dividends. Now the tax traps, the insufficient funds that generate ordinary income. This is where the person that we're talking to came into and had the issues, okay? They've watched the videos. They had the ideas. I want to invest into these things. I want the great income. I want development of my income across the board. Unfortunately, they weren't using it in their 401k. They were doing it separately. Devo, the Amplified Enhanced Dividend Program. We've talked about Devo quite a bit on the channel. the problem is the qualified rate is about 46% of the fund is qualified. Okay? That means 54% is ordinary income. So the tax impact is mixed. So you're going to get hit heavy on 54% of the funds that you receive from Devo. JEPI. I love JEPI. Don't get me wrong. I'm not against it. But when you have it in the wrong account, you're going to pay dearly for that. A qualified rate, 15%. That means 85% of their funds are coming to you as ordinary income. 15% is qualified. So JEPI, as I said, great fund. Should be in your 401ks, should be in your IRAs. It shouldn't be in a brokerage fund. Okay? Because of the tax implication. QYLD, exact same thing. QYLD from Global X. Like the fund. Again, another one. I own JPI. I own QYLD. I actually own Devo. But they're all in 401k funds. Okay? Because 100% of the qualified income from QYLD is going towards your tax income. It's hurting your bracket. Sure, you can have up $131,000 in tax savings. But if you're doing more than that with these, or you're doing something different, these are the killers. If you just move these to the right funds, transfer them to the right funds, you could change your whole world of taxation and actually increase your income. So the case study. Now, I did not put people's names onto it, and I changed things around a little bit. And the whole thing is this. So I'll call it Steve the plumber. This is our real world scenario. This is what I was faced with, what they walked into me with. The annual salary of $89,247 is what they generated. I said, they have the gross salary. I said, you're talking right now, your taxable ordinary income is $57,047. I said, we're trying to get you into where you're having the goal of maximizing zero taxation. Okay, so with all this, he has room for dividends. He has a $41,000 opening that he can invest into dividends as income and never is going to change his tax ration. So we know what his W-2 is going to be. We know his standard deduction because he's married. So we get down to it, $57,000 is ordinary income. Now he can turn around and have room for his dividends. But because Steve put the wrong funds in the wrong package, he blew past his $41,000. So scaling up the $2 million scale program. If you had a same size portfolio, and this is how I explained it to him, is that if you had the same size portfolio, you had a vast different tax outcome. If you would have taken and put your money into SCHD, which paid 3.3% income, versus your JEPI, that paid 7 to 10%. Okay, you would have generated $66,000 of income. Okay, so it falls completely within the standard deduction and the 0% tax bracket of that $131,000 limit. You'd pay zero in taxes. Now, because of your JEPI being put in the wrong account, that 7 to 10% yield that you were getting generated your $140,000 of annual income. You paid $16,000 in taxes. So you granted $140,000 you collected from it, and you got to pay $16,000 in federal taxes. I get that. You switch the two accounts. Switch it, your Charles Schwab, from your 401k, pull that out, put that into your regular investment, take your JPI, put that into your 401k, and I just wiped out $16,000 cost to you by just making one quick switch in 2026. He couldn't believe what we actually were showing him. He couldn't believe that it made that big of a difference by having which funds go into which accounts. I said, yes, this is all part of planning in your portfolio. So optimization, the strategic account placement. Everyone has, I really find this is almost what we suggest people with. You have a brokerage account. Okay, you have a taxable brokerage account. And why do you have that? Is because you can get the money in and out without any rules, penalties, or anything about it. Then you always start a 401k, which most jobs will have a 401k, or you start up a Roth, and those all have penalties. So if I need money out of a 401k and I'm not 59 and a half, I'm going to pay a 10% penalty. So I'm not going to be pulling money out of this fairly regularly. I'm not going to be pulling money out of a Roth IRA or a 401k. If I need money and income, I'm going to my taxable brokerage account. So what you want in your taxable brokerage account is qualified dividend income. Okay? Why do I want qualified dividend? Because it's eligible for the 0% federal tax rate. While the Roth are going in taxed and coming out tax-free forever. And while the 401ks have the tax deferred on the growth, different funds go into different spots to maximize your tax returns. These are how I'll call it I'll put it as the rich can do it. This is how investors can do it. This is how the people understand the system can do it. This is why we bring it down to the lower level. The people who can't afford the financial advisors and accordingly. This is a simple way of saving you money. So as you can see, we got the Charles Schwab, the VYM, the VIG, all in the brokerage account. We made the switch to JPI, JPQ, QYLD, RYLD, and then his REITs were put into the IRAs. And then we had his bonds, corporate bonds, and the high turnover funds were in his 401k. All this balanced out to virtually eliminate his taxable costs. So the triple threat and the boosters, the HSA, that triple tax advantage, the taxable income, the tax-free growth, and the tax-free withdrawal. And then REITs, okay? These are other big things. These are the things that you start adding into it that supercharges your returns. The HSA is your health care. And your REITs, I love REITs across the board. Okay? Because of what they do. The dividends are usually unqualified, so they have a tax at higher rates. However, there's tax codes to give special discounts because they want people investing in the homes. The Section 199A deduction, 20% of your REIT dividend income is cut off immediately. It's like a standardized deduction, but it's a bonus on top of that. So your taxable income of a $10,000 income from REITs is only $8,000. So we've reduced it again. So there's so many things behind it that we have that you have to use accordingly to help you continue to add and more to reducing your tax burden. So the new tax reality, that one beautiful bill that passed, that no one really understood what was going on, and is this going to be good for us? And you hear Donald Trump and talk about it all the time. You hear the Democrats complain about it when it was going through. Here's the reason why. We locked in the 7-bracket system. The tax cut, the jobs cut, the structure that made it permanent. We will not revisit the higher pre-2027 rates. The top rate was retained at only 37% taxing. We retained the higher deductions. This is what makes it so exciting that we got that up to $131,000 tax-free strategy by using that $32,000 for married people for the deductions. The SALT cap relief increased. And then we also took a look at the zero rate preserved. I think this is the biggest point of it. When we start looking at the higher deductions and that 0%, was the two things that I was excited about when I saw the bill get passed. I'm like, this is going to change a lot of different things. So the goal is the early retirement dream. All right, when Steve, basically I'll say, Steve, get yourself fired because you're going to be in a great position that you have 100% dividend income. You're going to live in Florida, which currently he does. And the math for 2026, you take your qualified dividends at $65,000, you take your deduction, even if you were single, down to $49,450, you fall right in the 0% tax bracket, buddy. you don't pay. So it shows it's not just married couples. It kind of put it into another example here, kind of switched it on you a little bit, but show you a single person can do the same exact thing. These things work well, especially in Florida, where you have that zero tax haven, like Texas, Nevada, Tennessee. These things all work really well together. Now, just a couple of finishing things. The ceiling and the next steps. When you get to it, the mastering the art of that tax efficiency income, the critical watchouts. Net investment income, which is basically what's called tax, NIIT. It's a 3.8% surf tax. It kicks in on a modified AGI exceeds $200,000 for a single, but only $250,000 for a married couple. So even dividends get hit by this surcharge, no matter what, qualified, non-qualified, doesn't matter, at the high income levels. The other one is the 60-day rule. To be qualified, you must hold the stock for more than 60 days during a 121-day period around the X date. So they're not looking for quick flippers, okay? You got to hold it to get qualified. So you want to structure your portfolio for you and not for the IRS. Tax efficiency is powerful. It shouldn't be an override to your core investment goals. But the zero tax is just the cherry on top of a solid income producing strategy. Okay, guys. So we help you here with taxes. We help you here with retirement portfolios. We're here to try to help you across the board, giving you just the plain Jane information. Let me know your comments below. Leave a comment. If anything, hit that like button. If you like what we're doing with the videos, it helps the channel the most. And if you're not, don't be afraid to hit the subscribe. And we'll catch you next time.